Hello everyone. Present here virtually. I am Sakshi here, and I will welcome you to all for today's session, which is titled as uh, Monetary Policy in the Context of India. And presenting this session, we have with us our today's expert, Miss Ekta Garg, ma'am. Miss Ekta Garg, ma'am, joined Vivekanand School of Economics, VIPS as an assistant professor. She earned her Bachelor of Art honors in economics from Sri Guru Gobind Singh College of Commerce, University of Delhi, and a Master of Art in economics from Delhi School of Economics, University of Delhi. She has qualified UGC NEET in economics. Previously, she has worked as a guest lecturer in Zakir Hussain College, University of Delhi. Also, she worked as a risk analyst in a HSBC and dealt with international clients. Her interests lie in microeconomics, game theory, public economics, and growth theory. She has participated and presented papers in the various national and international conferences. You may start now, ma'am.
Thank you so much, Research Circle, for giving me this opportunity. So, the topic for today's discussion is monetary policy in context of India. So, we will be discussing what is monetary policy and how it works in India. Right. So, Sakshi, can you please change the slide? Yes. Now, what is monetary policy? So, monetary policy is action taken by the monetary authorities of the country, that is the central bank. For India, we have RBI, right? So the policy action taken by the central bank RBI for a country in matters of interest rate, money supply, credit availability is the monetary policy, right? Next. Right. So as you can see that monetary policy refers to the policy of central bank. In India, it is Reserve Bank of India in matters of interest rate, money supply, and availability of credit. Next. Next slide.
Wait a minute, ma'am.
Now, what are the objectives of monetary policy? Right. So, first and the foremost objective of the policy is to ensure price stability or control the inflation. It is the primary goal for the monetary policy. Why? Because the other goals like economic growth and exchange rate stability are also aligned with the price stability. If inflation is rising in our economy, right, then our growth will be jeopardized. Right. Similarly, if the inflation is there in the economy under the flexible exchange rate system, our economy, our currency will depreciate, further denting our economy. Right. So price stability, since it is totally aligned with our other goals of economic growth and exchange rate stability, it is the main policy of the RBI. Right. So how RBI ensures that it is able to maintain the price stability? So we have flexible inflation targeting framework, right? Then we have monetary policy framework, we have monetary policy committee, then monetary policy process and monetary policy instruments. We will see them one by one in detail, right? Next slide. When we talk about flexible inflation targeting framework, so this is after 2016 amendment in the RBI Act, we are able to get some flexibility in inflation target. So if we have a target, let's say 5%, right? So we will be having some flexibility around this target, some upper tolerance and some lower tolerance, so that it becomes easy to achieve our target, right? Now, who framed the policy? Like who framed the inflation target? So it is the Government of India authority to design the inflation target in consultation with RBI, right? And it currently the inflation target is 4% with upper tolerance limit of 6% and lower tolerance limit of 2%, right? And if if RBI is not able to ensure, this bracket of inflation, then we say that there is a policy failure. So we can say that if we have more than 6% inflation and less than 2% inflation in the economy for consecutively 3 quarters, we say that there is a policy failure in our economy, and certain other actions need to be taken to ensure we are reaching our target. Next, now talking about monetary policy framework. So it is the sole authority or explicitly given to the RBI, and it is a legislative mandate to the RBI to operate the monetary policy framework of the country. So even though Government of India designed the target, inflation target, but to ensure we are reaching this target, it is the mandate of the RBI, right? And for this, it aims at setting the policy repo rate. You must have heard of repo rate. Recently also RBI has increased the repo rate to control the inflation. Now, why it is called the policy rate as well? So, why it is called the policy rate? Because other rates of our economy are related to repo rate. Repo rate is a rate at which RBI gives overnight money to the commercial bank to maintain liquidity in the banking system, right? So if repo rate increases, it means it increases the cost of commercial bank, right, to get the money to ensure the liquidity in the banks, right? And if their cost will increase, right, they will try to reciprocate or give this cost to the consumers. That is by increasing the market interest rate. If the market rate interest rate increases, it will influence the consumption and investment behavior, right? For example, if home loan increases or if car loan increases, then the interest rate increases, then consumers have the disincentive to buy car or to buy home. So it will decrease the private consumption. Similarly, if interest rate increases, it will increase the cost of investment, right? It becomes costly to invest, so it will further disincentivize investment, private investment in the economy. When both consumption and investment are getting disincentivized or reduces, then it will negatively affect the aggregate demand curve, and our GDP level and the output level and employment level will also be affected negatively. Similarly, if the repo rate reduces, right, so it becomes easy for the commercial bank to get the loan from the RBI to maintain liquidity. So it becomes they will reduce their market interest rate. Now, when the market interest rate reduces, it will induce the consumers, right? When home loans and car loans are cheaper, it will incentivize consumers to buy cars, buy homes. So it will positively impact the consumption. Similarly, the cost of investment reduces, so investment also increases. When consumption and investment increases, it will provide give a boost to the AD, and further it will help the economy to revive itself. Right. So since repo rate has the potential to completely impact the inflation, the output, employment level, that is why it is called the policy rate. Right. Then, uh, as a repo rate is designed, we will try to manage the liquidity in the monetary policy framework. Next. Now, Monetary Policy Committee. Now, this is a recent committee which is framed after only 16 amendment in the RBI Act. Now, this Monetary Policy Committee becomes the authority to ensure that we are able to meet our inflation targets, right? And as per the constitution of this Monetary Policy Committee, we have 6 members in the committee, in which 3 members are appointed by the government. They are the expert in the field, right? And 3 members are from the RBI. So, governor of the RBI is one of the members. Then, deputy governor general is the member, and one expert from RBI is the member, right? And as per the constitution of this committee, the members need to meet at least 4 times in a year, right, to discuss the macroeconomic issues, and at least 4 members need to be present. The quorum has to be 4 members to ensure that a meeting can be proceed successfully. Once the meeting gets done and decision has been taken, the resolution adopted by the MPC is published after the meeting on the RBI website, right? And RBI is also mandated to publish the document called Monetary Policy Report, right, every 6 months, right? Once in every 6 months. And in this report, they have to mention the sources of inflation in the economy, and also what is their prediction or forecast of the inflation for the next 6 to 18 months ahead, right? So, Monetary Policy Committee is a very new committee, and it has given the very big responsibility to ensure price stability in the economy. Next, now monetary policy process. Now, once the inflation target has been established, right? Uh, Monetary Policy Committee will determine the policy interest rate, that is repo rate, which is required to achieve the inflation target, right? And Monetary Policy Department, right, will assess the MPC, Monetary Policy Committee, in formulating the monetary policy, right? So they will look into the macroeconomic, view of the economy. They will also keep in mind the views of various stakeholders in the economy. What should be the requirement of the economy, right? So that we can accordingly take action. Also, data analysis has been done to achieve the so that we can achieve the inflation target. So we need to ensure that in order to achieve the inflation target, we are choosing the best repo rate, best policy rate. Post that, since the repo rate has to be maintained and it has to align with the call money market rate, right? So the financial market operation department, right, it has to operationalize the monetary policy through day-to-day liquidity management operations, right? So to ensure that we have properly managed the liquidity, right, and repo rate, if repo rate is completely aligned with the liquidity management call money rate, right, so we can have a effective monetary policy, right? And financial market committee meets daily to review the liquidity conditions in the economy, right? Since liquidity manage is not a quarterly task or a monthly task, it is a day-to-day activity, right? So the committee has to meet daily to ensure that we are meeting our liquidity conditions, right? To ensure that the call money average call money, call money rate is aligned with the repo rate, is equal to the repo rate. Otherwise, the monetary policy may become ineffective. Next, now talking about monetary policy instruments, right? So we have many monetary policy instruments. I have included few. These are quantitative monetary policy instrument. So first in this is cash reserve ratio, right? So what is cash reserve ratio? So commercial banks have to keep certain money, certain amount of money as per proportion to their net demand and time liabilities, right, with the to ensure that there is liquidity in the economy, right? So certain proportion or certain percentage of net demand and type liabilities, whatever deposits basically commercial bank attains, so certain proportion, the commercial bank have to reserve those amount, right, on daily balance, right, to ensure that we have liquidity in our economy, right? Because if a commercial bank, give away all their deposits, right, for lending, what the commercial bank does to earn money, it gives loans to the people, right? Once it attains the deposit, right, that money is used to provide loans, right, so that an economy can function, an economy can grow, and also banks will earn with the help of interest rate, right? So obviously the bank's motive is to increase the profit, and they would like to give all of their deposit to the lending facility so that they can have more and more profits, right? But this might create the problem of bank run in the economy if all the funds are are given in the lending form. There is nothing left with the bank. So if any person wants to buy something, the bank will not be able to give the money to their consumers or the depositors, right? Then it might create a problem of bank run. To ensure that we do not face this problem, so RBI ensures that we have a cash reserve ratio. Some certain proportion of the deposit are kept with the bank, right? So that we do not face any problem. And it is, this is notified by RBI in the Gazette of India from time to time. Similarly, we have statutory liquidity ratio. Now it is mandatory. Statutory means legally. So banks are legally binded to ensure that they are keeping certain proportion of net demand and time liabilities. Now it has to be in the liquid form. For example, cash, liquid assets, dollars, something which is very liquid, right? So banks have to keep a share of NDTL, right, net demand and time liability, in safe and liquid asset, uh, like government securities, cash and gold. And change in these ratio will affect the economy or the funds available in the economy. For example, if RBI increases the statutory liquidity ratio, right, or CRR, what will happen? Now banks have to keep more money in the reserve, right? And let's say a bank have 100 crore rupees, right? And CRR earlier it was 30%, so banks have to keep 30%, 30 crores in the reserve. But now if it increased to 40%, so now banks have to keep 40 crores, right? So this 10 crores are again blocked, right? So the profit which could have been earned on these 10 crore have to be foregone, right? And these 10 crores which would be available for the investment purposes are not available now, right? So if CRR, SLR increases, this means less funds are available in the economy for investment, right? So if investment reduces in the economy, what happens? The aggregate demand will fall down, thus adversely affecting the GDP, employment, and output. Right. Now, liquidity adjustment facility. So, basically, one more thing. Right. Liquidity adjustment facility. What is this? Liquidity adjustment facility. It is an overnight mechanism. Okay. Because bank needs fund for overnight to ensure liquidity. Right. And this is also in terms of repo auctions. What is repo? Repurchase agreement. Right. So we have two instruments in this liquidity adjustment facility: repo rate and reverse repo rate. Right? In this, RBI provides funds to commercial bank, and commercial bank provides funds to RBI, right? But with a repurchase agreement, right? So we can see that in detail with the help of the repo rate. Now, repo rate, I have already explained. It is the rate decided by RBI, right? At which RBI provides funds to the commercial bank on overnight basis and on repurchase agreement. So when the RBI is giving funds to the commercial bank, then commercial bank has to give some collateral. So have to keep some collateral. It can be government securities or any other approved securities by the RBI, right? And it is done with the repurchase agreement. That is, commercial bank promise them that they will buy this agreement or buy these collateral in some time, right? So there is a repurchase agreement, and repo rate is and commercial banks get the loan from RBI for overnight basis to maintain liquidity. So it is only to maintain liquidity in the economy that uh, commercial bank needs to resort to the repo rate. Now, if the repo rate increases, so what happens? If the repo rate increases, it forces the bank to increase their cost of lending, right? Because as their cost of lending also increases, they will, redirect it to the consumers who are going to buy loan from them, right? And as the cost of loans increases, this will negatively affect the investment and consumption. And when both consumption and investment reduces, this reduces the aggregate demand curve in the economy and does negatively impact the GDP level in the economy. Right? Similarly, if repo rate reduces in the economy, so it reduces the cost of borrowing by the commercial bank. It is more profitable for them to buy from the RBI the funds, and then they are also forced to reduce the market interest rate of the economy. Right? As the interest rate it reduces in the economy, it will provide boost to increase the consumption or boost to the investment, thus promoting the growth in the economy. Slide. Sakshi. Sakshi, am I audible? So I think Sakshi dropped out. Anyways, so post repo rate, we have reverse repo rate. This is the rate at which commercial bank provides loan to the overnight loan to the central bank, RBI, right? So if commercial bank are giving loan to the RBI, it means they want to reduce the liquidity in the economy on an overnight basis. Okay. And RBI also get the loan from the banks against the collateral with the repurchase agreement, right? That once they are getting the loan from the RBI, they will give it back to the commercial bank, and against that they have a collateral. They have to give the collateral in the form of government securities or approved securities, right? Then we have marginal standing facility. So it is a recent initiative by the RBI. So under this facility, a commercial bank can borrow an additional amount of overnight money from the Reserve Bank by dipping their statutory liquidity ratio to a limit at a penal rate of interest. Right. So basically, if banks breach their statutory liquidity requirement, then they can get they get the lending from the RBI on overnight basis, but at a penal rate of interest. Right, because SLR is a statutory mandate, right? And if the banks are not abiding the statutory mandate, they have to be penalized. So marginal standing under marginal standing credit facility, it is a penal rate, so it is higher than the repo rate, and usually it is 1% higher. So if the repo rate is 4%, this penal rate will be 5% in the economy, and it will act as a safety, valve against the unanticipated liquidity shock to the banking system, right? So just in case banks are not able to meet their SLR, right? So they have an option to revive through the marginal standing facility, right? They can always go back to the bank and get the loan on the penal rate. There is a provision to this, right? Then we have open market operations. What are open market operations? Basically, these are way to increase or decrease the money supply in the economy, right? So if RBI wants to increase the money supply in the economy, how it can increase the money supply in the economy? If it buys treasury bills, right? So if it buys the treasury bills from the people, then in order to buy, it has to give the money, right? So if in order to increase the money supply, the RBI buys the treasury bills from the people of the country. Similarly, if RBI wants to decrease the money supply in the economy, then what it needs to do? It needs to sell the treasury bill. So when people buy the treasury bill, they have to give their money to the RBI, thus reducing the money supply in the economy. Now it has an impact on the economy. If the money supply increases, what happens? If the money supply increases, it will increase the purchasing power of the people. And with more purchasing power, they will increase their demand. So basically, consumption will increase, investment will increase, right? And with positive impact on the consumption and investment, it will have positively affect the aggregate demand in the economy. So you can see that post COVID, right, there was easy monetary policy, right? So under easy monetary policy, they are trying to reduce the interest rate in the economy. They are trying to increase the money supply in the economy so that we can have a favorable impact on the economy. Similarly, when in a boom period, when the economy is growing at a very fast rate, right, and it leads to the inflation in the economy. When the economy is growing at a very fast rate, it has used all of its resources, right? Then it becomes difficult to increase the production without increasing the prices. So it leads to inflation. Right. Now, in that case, to control the inflation, one measure is to reduce the money supply in the economy by selling the treasury bills to the people. Right. So when the money supply is reduced, it will also reduce your purchasing power in the economy. When the purchasing power reduces, you will demand less. There will be less consumption. There will be less opportunities to invest because people do not demand. So why the producers will produce, right? So it will impact your consumption and investment negatively, and thus reducing the GDP in the economy, thus reducing the output in the economy, employment in the economy, so that we can again target the inflation in the economy. So these are some quantitative measures. Then we have some qualitative measures to ensure, right? So one tool under this is moral suasion. What is moral suasion? So we must have seen that once RBI reduces the repo rate, the policy rate. It wants a commercial bank to reduce their market interest rate so that the monetary transmission mechanism can work, right? But commercial bank do not want to reduce their market interest rate because it is the only source of revenue. In case RBI increases the repo rate, commercial bank definitely increase the market interest rate so that they can cover their cost. But when RBI reduces the repo rate, the commercial bank are hesitant to reduce their market interest rate. But if the commercial bank do not reduce the market interest rate, the monetary transmission mechanism cannot work, and we will not be able to see the impact of the monetary policy. So in that case, RBI holds a press conference, and under this, it directs the commercial bank to follow the guidelines of the RBI, and it has to reduce their market interest rate then onwards. That is moral suasion. Morally, they are trying to, ask the commercial bank to comply with the RBI guidelines. Then we have a margin requirement. So whenever banks are giving loan, right? So banks have to keep some collateral and it has to some margin. For example, if someone wants a loan of 10 lakh, the person has to give a collateral of at least 15 lakh, let's say, right? So this margin of 5 lakh is decided by the RBI. If the margin requirement increases, it makes it difficult for a people to get the loan from the banks, right? Since they have to bring more amount of collateral, right? So if the margin requirement increases, it will provide this incentive to borrowing, right? And when borrowing reduces, it will negatively affect the consumption, investment, and hence aggregate demand in the economy, right? And if margin requirement reduces, right? So what happens if the margin requirement reduces? It will become easy for the borrowers to get the loan from the commercial bank, and hence the borrowing activity will increase, investment will increase, consumption will increase, and it will positively impact the aggregate demand curve, right? Then we have qualitative credit. So there is some mandation, right? RBI mandate commercial bank to give certain amount of a loan to priority sector. Now, what are these priority sectors which are of prime importance for the economy? For example, agriculture, women empowerment, environment sustainability, right? So these are very important sector for the economy, and hence the government wants that these people should get the loan. So it is mandatory for the commercial bank to provide the loans to these sectors. Certain proportion they have to give to this sector, failing which an action has been taken against them. Right. So these are some of the ways in which the RBI or the monetary policy can direct the economy in the way. Right. Now, when we talk about monetary policy, it is of two types. It can be either expansionary or contractionary. When we say expansionary monetary policy, it means that we are using the monetary policy tool such that it has a expansionary impact on the economy. When we say expansionary impact, it means we want to increase the income in the economy. We want to increase the GDP of the economy, output, employment in the economy, right? And as we can see from these tools, and we have already discussed, if we reduce the CRR, if we reduce the SLR, right? So banks will be able to provide more loans to the people, more funds are available for lending activity, right? And thus positively impacting the economy, right? Similarly, if the repo rate and reverse repo rate reduces, what happens when the repo rate and reverse repo rate reduces? It becomes easy for the commercial bank to get loan, right? And they will also reduce their market interest rate, positively impacting the consumption and investment in the economy, and thus aggregate demand, output, employment in the economy. Similarly, if the government increases the money supply in the economy, right, through buying the treasury bills. If the RBI buys the treasury bills, it increases the money supply in the economy. More purchasing power with the people. They will consume more, they will invest more, and thus increase the employment in the economy, output in the economy, and GDP of the economy. So this is how government tries to use a monetary policy to expand the economy, right? And this happens during recession time and when the economy thinks that we are below our potential level. So the monetary policy can be an effective instrument to revive the economy, right? And in case of contractionary monetary policy, we need to increase the CRR, SLR. As the reserve requirement increases, bank have less funds available for the lending activities. less fund available for the economy, right? So people will be, less fund available, so their consumption and investment will be reduced, and thus it will reduce the output in the economy, employment in the economy, and GDP level of the economy. If repo rate and reverse repo rate increases, then it becomes costly for the commercial bank to get the loan, right? And they will increase their interest rate. This will provide this incentive to reduce the, they will reduce the consumption and investment, thus reducing the output in the economy, employment in the economy, and GDP level of the. Similarly, open under open market operation, the money supply has to be reduced, right? And in order to reduce the money supply in the economy, the RBI needs to sell the treasury bills to the people, right? Once the treasury bills are sold, the purchasing power of the people is less, and with less purchasing power, they will be consuming less. There will be less investment in the economy, and thus they will have a low output, employment, and GDP in the economy, right? So that is how the RBI tries to use their instrument to ensure we are meeting the economic requirement of the economy, right? So this is with respect to the monetary policy of India. Thank you so much for listening to this session. Thank you.
Thank you so much, ma'am, for this nice session. If anyone has question, you can ask. I think no one have any question, ma'am. Thank you so much, all the participants, for your active participation. Let me inform to uh, all this complete session will available on YouTube, our Research Circle YouTube channel. So if you want to watch it again or want to share it somebody, please do visit the Research Circle YouTube channel. Thanks. And last but not the least, thank you, Miss Ekta Garg ma'am, for taking our time for session. With our permission, I would like to end today's session here. Thank you, ma'am.
Thank you so much.